Welcome back to The Deep Dive. Today, we're going to tackle something really interesting, a kind of financial puzzle.
hmm
How do you get exposure to Bitcoin, one of the, well, most talked about assets out there, without actually getting tangled up in the crypto weeds?
That's exactly it.
Yeah.
I mean, Bitcoin's huge now, right? People call it digital gold, a new store of value, even a hedge. But let's be honest, for most regular investors, people using traditional brokers, actually buying and holding Bitcoin, it's still a pretty big headache.
Oh, it's a hurdle, for sure. You've
Yeah.
got the whole digital wallet thing, seed phrases you can't lose, worrying about exchanges getting hacked, and, that constant low-level anxiety about self-custody. Like, if you mess up your private keys, poof, your money's just
Right.
gone. No bank to call.
Right. That fear is a real barrier. So our mission today for you, the learner listening in, is to kind of be your guides through this. We've dug into a bunch of sources and we found five structured, totally legitimate, regulated ways you can get significant Bitcoin exposure
Without touching a token.
without ever managing a crypto token directly. No wallets to download, no private keys to stress over.
Okay, let's unpack that because this isn't just theory anymore, is it? Something's really shifted. Why is now, like 2024 onwards, the moment this whole indirect investing thing is taking off?
It really comes down to one thing: institutional validation. Wall Street, traditional finance, TradFi, they're not just kicking the tires anymore. They are actively building, well, a massive bridge straight into the crypto world.
Our bridge.
Yeah, a well-regulated one. The idea that Bitcoin was just for like tech enthusiasts or cypherpunks, that's kind of fading fast. Big money, institutional capital, they want in. And now they're regulated products that let them.
So say I'm listening, maybe I run a small business, manage my family's investments, or I'm just trying to figure out my retirement savings. What are the actual tangible benefits of going this indirect route versus, the wild west of holding it myself?
Well, first off, you get professional-grade infrastructure, and it's accessible. You immediately avoid those big security risks, the compliance headaches of direct ownership. But maybe the biggest thing: flexibility and diversification.
How so?
You can slot Bitcoin exposure right into your existing accounts. Your IRA, your 401k, your normal brokerage account. Places you already understand and trust.
Ah, okay. So it brings Bitcoin into the fold, tax advantages and all.
Exactly.
Ah,
It makes it feel like, well, just another asset class you can hold alongside stocks and bonds.
yeah.
The safety net of traditional markets meets the, let's say, potential upside of digital assets.
And that legitimacy, that regulatory green light we saw, especially with the ETFs,
Yeah.
it wasn't just opening a door, it was more like knocking down a wall, right? Suddenly Bitcoin is on the table for serious financial players.
It really changed the game, made it a viable asset class for global finance.
Okay, so option number one has to be the big one, the one everyone's talking about, the spot Bitcoin ETF. Seems simple, but let's get specific. What exactly is it? What are you buying beyond just a ticker symbol?
Right. So when you buy a share of a spot Bitcoin ETF, think BlackRock's IBT or Fidelity's FBTC, those are the big ones, you're buying a security that trades on a major stock exchange, just like Apple or Google stock.
Okay, simple.
But here's the crucial part. By regulation, that ETF share is backed by real Bitcoin. The fund actually holds the underlying Bitcoin in secure custody on your behalf.
So if Bitcoin goes up 2%, the ETF share price should theoretically go up pretty much 2% too, minus any small fees, I guess.
That's the idea, yeah. Minimal tracking error. And the beauty of it is the sheer convenience wrapped in that regulatory blanket. Use your existing Fidelity account, your Schwab account, whatever.
No new apps, no weird crypto exchanges.
Exactly. You skip the whole wallet setup, private key anxiety, the sometimes sketchy world of unregulated exchanges. It just plugs right into your normal financial life.
Now, you mentioned custody. If I'm giving up holding my own keys, where's this Bitcoin actually kept? Because, trust is a big issue here.
That's central to the whole institutional buy-in. These big ETF providers, they don't just stick the Bitcoin on a USB drive in the office. They partner with established, heavily regulated institutional-grade custodians.
Like Coinbase, I hear their name a lot.
Coinbase Custody is a major player, yeah.
Yeah.
They provide the secure vault, essentially, for many of these ETFs. We're talking multi-layer security, cold storage, meaning offline storage, comprehensive insurance, all designed to meet the standards expected by, well, multi-billion-dollar institutions.
So the risk, the burden of keeping it safe, shifts from my laptop to their institutional vault.
Precisely. And that level of security and regulation is what makes them eligible for retirement accounts, like IRAs and 401ks. That was almost impossible before.
Yeah, that's a huge deal. Getting Bitcoin into tax advantage accounts legitimizes it for long-term planning, not just quick trays.
It totally changes the conversation, makes it a potential retirement asset.
Okay, but let's talk impact, because this wasn't just a trickle of interest, was it? The floodgates kind of opened when these got approved.
Oh, it was staggering. Unprecedented, really. After the SEC gave the green light in, was it January 2024, the money that poured in was immediate and massive. Our sources show over $20 billion flowed into these spot ETFs within just the first few months.
20 billion.
Yep. More than anyone really expected for a new ETF launch. Way more.
And that's coming from traditional investment channels, right? Not just existing crypto money moving around.
Primarily, yes.
Yeah.
Regulated traditional capital. And think about what that means. It's pure supply and demand. All that money flowing in forces the ETF managers, BlackRock, Fidelity, to go out and buy equivalent amounts of actual Bitcoin on the open market to back the shares they're issuing.
So the ETF demand directly creates buying pressure for Bitcoin itself.
Directly. And that sustained, large-scale institutional buying, that's what fueled that big rally we saw, pushing Bitcoin past $70,000. The link is undeniable now. ETF flows are a major force driving the Bitcoin price.
Okay, I gotta push back slightly, though. It sounds easy, but nothing's free. You give up self-custody, you avoid the tech headaches, but there's a cost, right? A fee. And doesn't that kind of go against the original Bitcoin idea of cutting out middlemen?
That's a fair point and important for you listening to understand. Yes, there is a cost. These funds charge management fees. They're generally small, usually in the 0.20% to 0.25% per year range.
0.25% annually?
Okay. It's not huge, but it is a cost. However, you have to weigh that against the potential cost of doing it yourself. The risk of getting hacked, the stress, the learning curve, and crucially, the risk of losing everything if you mismanage your keys.
So for most people coming from traditional finance, that small fee probably feels like a reasonable price for institutional security and simplicity.
That's how many see it, yeah. It's the price of delegating the complexity and the risk. It's a trade-off. You gain accessibility and safety, but you embrace a degree of centralization. That's a recurring theme here.
Definitely something to keep in mind. All right, let's shift gears to option number 2. This is quite different. It's less about directly tracking Bitcoin and more about using the stock market itself, buying shares in companies that hold a ton of Bitcoin.
Exactly. We call this the buying the treasury proxy strategy.
No.
The idea is simple. You invest in publicly traded companies that have made a strategic decision to hold significant Bitcoin on their balance sheet, usually as a primary reserve asset.
So buying their stock gives you sort of indirect exposure to Bitcoin's price swings.
Indirect and often amplified, because the company's stock price tends to react not just to the Bitcoin price, but also to the market's perception of their strategy, their debt, their core business. It gets interesting.
And the absolute king of this strategy, the one everyone points to, is MicroStrategy, MSTR.
Oh, absolutely. MicroStrategy basically invented this playbook, or at least perfected it at scale. They've been incredibly aggressive, accumulating Bitcoin relentlessly. They hold, what, over 200,000 BTC now? Worth, north of $14 billion last I checked. So for a traditional investor, buying MSTR stock isn't really about buying a software company anymore. It's become the most concentrated way to bet on Bitcoin through the stock market, outside of an ETF.
Okay, let's spend a bit of time on this leverage proxy idea, because this is where the numbers get kind of wild, right? The stock moves way more than Bitcoin sometimes.
This is the key thing to grasp. Why does MSTR stock often jump, say, 3x, when Bitcoin only jumps 40%? There are a couple of reasons. First, leverage. MicroStrategy often finances its Bitcoin buys using debt, specifically convertible notes.
Meaning they borrow money, effectively betting they can pay it back easily if Bitcoin's price goes up, potentially by issuing more stock later.
Pretty much. They're using borrowed funds to acquire more Bitcoin. So if Bitcoin's price skyrockets, the value of their holdings explodes relative to the debt they took on. That leverage acts like a magnifying glass on the gains.
Okay, leverage makes sense. What's the second factor?
It's market perception, or what you might call a premium. The stock market doesn't really value MSTR just as a software business plus its Bitcoin holdings. It sees it as a unique, aggressive Bitcoin investment vehicle.
So the price reflects excitement about future Bitcoin gains.
Exactly. Investors often bid the stock up beyond the current value of its assets, anticipating future appreciation or more aggressive buying. It trades on momentum and sentiment as much as fundamentals.
And that explains that crazy example from early 2024. Bitcoin rallies 40%, MSTR stock triples. That's serious leverage.
It is. But, and this is a big, but leverage cuts both ways, hard. When Bitcoin drops, MSTR stock tends to fall much further and faster.
Because the premium evaporates and suddenly that debt looks riskier.
Precisely. Fear replaces greed, the leverage works in reverse, and concerns about their ability to service the debt amount if the asset value tanks. So it's definitely high risk, high reward, neatly packaged in a NASDAQ Q ticker. Not for the faint of heart.
Understood. Now, MSTR is kind of an extreme example, putting almost everything into Bitcoin. What about other companies where Bitcoin is important but maybe more integrated into their actual business, not just sitting on the balance sheet?
Yeah, there are other ways to get exposure through stocks. You could look at companies weaving Bitcoin into their services. Tesla, TSLA, for instance, they've held Bitcoin reserves, bought some, sold some. It fluctuates.
So maybe less of a pure Bitcoin play than MSTR.
Definitely less direct, more influenced by their core car business and Elon Musk's latest tweets, frankly. Then you have companies building the infrastructure.
Like Block, OXQ.
Right. Block, formerly Square. They're deep into Bitcoin through Cash App, letting millions buy, sell, and even use Bitcoin. Investing in Block is more a bet on Bitcoin's growing utility and mainstream adoption in payments and finance.
Okay, so it's a bet on the ecosystem growing.
Yeah. And then there's Coinbase, CoinIN. We mentioned them as a custodian for the ETFs.
Right, the plumbing.
Exactly. Buying coin stock isn't direct Bitcoin exposure, but it's a bet on the overall health, trading volume, and institutionalization of the entire crypto market. Their revenue comes from transaction fees, custody services for those big ETFs. They are the infrastructure in many ways. Investing in them is betting on the pipes themselves.
Makes sense. Different flavors of indirect exposure.
So our next couple options, 3 and 4, zoom in on the companies actually building and running the nuts and bolts of the network. This is where things get maybe a bit more specialized.
Let's get into option 3 then. This one sounds potentially exciting, but also maybe kind of risky. Bitcoin mining stocks. The companies actually creating the new Bitcoin. So explain how miners like, say, Riot, Marathon, or Hut 8 actually make money, and how does that connect to Bitcoin's price?
Okay, so miners are essentially the bookkeepers and security guards of the Bitcoin network. They run powerful, specialized computers, ASICs, to solve complex math problems. When they solve one, they get to validate a block of transactions and add it to the blockchain.
And for doing that work.
They get rewarded in 2 ways. Transaction fees paid by users, and more importantly, newly created Bitcoin. This is the block reward. So companies like Riot, Mara, CLSK, HET, their core revenue stream is earning Bitcoin directly.
Ah, so if the price of Bitcoin doubles, the value of the Bitcoin they earn instantly doubles too.
Exactly. Their revenue is directly tied to the BTC price. This makes their stocks naturally leveraged plays on Bitcoin. When Bitcoin booms, their potential profits can explode.
But unlike MicroStrategy just holding Bitcoin, miners have massive real-world costs, right? Power bills, warehouses full of computers. That sounds fundamentally different.
It's a completely different beast. Huge operational complexity and risk. Yes, they benefit massively when Bitcoin goes up, but they face enormous headwinds. First, energy costs. They need vast amounts of cheap, reliable electricity. Power prices can make or break them.
Okay, energy is a big one. What else? Second, hardware. Those specialized ASIC miners become obsolete fast. There's a constant race to buy the newest, most efficient chips. If they fall behind, their profitability plummets. And third, maybe the trickiest part, is the dynamic between their own computing power, their hash rate, and the network's overall difficulty.
Whoa, okay. Hash rate, difficulty. Why do those matter to an investor?
Because the Bitcoin network is designed to produce a new block roughly every 10 minutes, no matter how many miners are competing. If the Bitcoin price surges, more miners jump online, increasing the total global hash rate.
More competition.
Right. So the network automatically makes the math problems harder. The difficulty increases to keep that 10-minute block time steady. This means each individual miner, even if they keep their machines running, starts earning less Bitcoin over time for the same effort, unless they constantly upgrade or expand faster than the competition.
It's like a treadmill they can't get off.
Yeah.
And then you have the halving. The halving is the scheduled event roughly every 4 years, where the Bitcoin block reward gets cut in half instantly. It's a massive supply shock baked into the code.
Which must crush the miners who aren't super efficient.
Absolutely. Post-halving, only the leanest operations with the cheapest power and best machines survive and thrive. The potential upside is huge. We saw mining stocks outperform Bitcoin by like 60% to 120% in that 2024 rally.
But the downside?
The downside is bankruptcy or heavy dilution if they can't manage costs or if Bitcoin's price falls. They are incredibly volatile. When Bitcoin pulls back, these stocks often crash much harder. You're betting on their operational skill just as much as on Bitcoin itself.
Definitely a high-octane play. Requires real conviction and tolerance for wild swings.
Okay, so if betting on a single miner feels too risky, but you still like the idea of investing in the underlying infrastructure growth, that brings us to option 4, diversified blockchain ETFs. This sounds, well, safer. It's definitely designed to be a broader, less concentrated approach. It's for investors who believe in the whole ecosystem, the entire blockchain economy, rather than trying to pick the winning mining company or the company with the biggest Bitcoin stash. It spreads the risk.
So what's actually in these ETFs? How do they diversify?
Well, you have funds like BLOK, that amplifies transformational data sharing ETF, or BKCH from Global X, or DAPP from VanEck. They hold a mix of companies across the digital asset space.
Not just Bitcoin-related stuff.
Not exclusively, no. They aim for a wider lens on blockchain technology. So if you peek inside, say, BLOK's holdings, you'll find a blend.
Give us an idea, like what?
You'll likely see some mining stocks, sure, like Marathon, to get that direct production exposure. But you'll also see key infrastructure players like Coinbase, the exchanges, the custodians. You might see tech giants like NVIDIA, who make the chips essential for mining and AI.
Okay, so the hardware suppliers, too.
Right, and maybe even companies like MicroStrategy for that balance sheet exposure. The goal is to capture the growth of the whole sector from different angles.
So investing in one of these is less a bet on Bitcoin's price tomorrow and more a bet that blockchain tech itself is going to be transformative for finance, data, whatever, and lots of companies involved will benefit.
That's the core idea. You're investing in the systemic shift, the overall trend of digital transformation. You figure a rising tide will lift most boats in this sector, and you don't have to guess which boat will float highest or sink first. It's a diversified bet on the future plumbing of the digital economy.
Got it. A more balanced, if perhaps less explosive, way to play the theme.
Okay, moving on to option 5. Now we're getting into slightly more niche territory. These are products often used by more active traders or institutions, offering Bitcoin exposure through traditional financial instruments, but maybe not ideal for everyone.
Right. We established these spot ETFs option 1 are kind of the go-to for long-term buy and hold in your IRA. So what's different about these other products? What's the catch?
The main example here is something like BITO, the ProShares Bitcoin Strategy ETF. The key difference is it's not a spot ETF. It doesn't hold actual Bitcoin.
It doesn't. What does it hold then?
It holds Bitcoin futures contracts. These are agreements to buy or sell Bitcoin at a set price on a future date.
Yeah.
They trade on regulated exchanges like the Chicago Mercantile Exchange, CME.
Okay. Futures? Why would that be less suitable for just buying and holding long-term?
It boils down to something called contango and roll costs. See, futures contracts expire. So for an ETF like BDO to maintain constant exposure, it has to continually sell the contracts that are about to expire and buy new contracts with later expiration dates. This is rolling the position.
Okay. Standard futures management. What's the problem?
The problem often arises when the market is in contango. That's when the price of futures contracts further out in time is higher than the price of contracts expiring soon, or the current spot price.
So when the ETF rolls its contracts.
It's effectively selling lower-priced contracts and buying higher-priced ones just to stay invested. Month after month, this creates a small but consistent drag on performance. It costs money just to maintain the exposure.
So the ETF price tends to lag behind the actual Bitcoin spot price over time.
Exactly. That roll yield decay can be significant, especially over longer holding periods. So while Bit2 was important, it was the first U.S. Bitcoin ETF allowed, and it's useful for traders wanting short-term exposure or hedging tools. It's generally not the best choice for someone wanting to park money in Bitcoin for years in their retirement account. The spot ETFs, option 1, are structurally better for that.
Gotcha. So BIB2A equals trader tool, spot ETF equals long-term holder tool. Makes sense. Bonus, crypto integrated fintechs, indirect access. Okay, let's talk about a bonus approach. This one feels like it taps into the bigger picture of adoption, investing in the big fintech companies that are increasingly playing in the crypto sandbox.
Yeah, this is more about betting on the on-ramps and off-ramps. As the core infrastructure, like the ETFs, makes crypto more stable and accessible, where are mainstream users actually going to interact with it? Often it's through apps they already use.
Like Robinhood adding more coins or SoFi.
Exactly. Companies like SoFi, Robinhood, and especially PayPal. They are integrating digital assets deeper and deeper into their platforms.
PayPal's move with their stablecoin, PYUSD, felt like a big step.
It was huge, a regulated dollar-backed stablecoin issued by a global payment giant. That signals they see a massive future in facilitating payments and value transfer using digital rails. They want to be a core part of that new economy.
So the play here isn't directly betting on Bitcoin's price going up, but rather betting that these huge established fintech players will successfully capture a lot of the new users and transaction volume coming into crypto.
Precisely. You're investing in the platforms that are bridging the gap between traditional finance and the emerging digital asset world. Their stock price should benefit if they can successfully monetize this wave of adoption through trading fees, new services, payment flows.
So it's an indirect bet on the growth and mainstreaming of the whole space, channeled through familiar, regulated companies.
Correct. It's scalable exposure to the digital finance trend itself, rather than a specific asset's price. Hashtag synthesis and takeaways.
Okay, we've covered a lot of ground. 5 distinct strategies, plus that fintech bonus, all designed to give you Bitcoin exposure without the direct crypto hassle. Let's try and synthesize this. How should you, the listener, think about choosing the right path based on, say, risk tolerance?
Right. Matching the strategy to your goals and comfort level is key. We can break it down pretty clearly.
All right, let's start low risk. Say I want the safest, most regulated route. I prioritize simplicity, low fees, ideally, and I definitely want it to be eligible for my IRA or 401k for the long haul. What's the move?
Unquestionably, the spot Bitcoin ETF like IBIT or FBTC, that's what they're built for. Regulated custody, easy trading, liquid, retirement account friendly, full stop.
Okay. Any other lowish risk options?
Well, if you want broader exposure to the whole sector rather than just Bitcoin's price, and you're still fairly conservative, a diversified blockchain ETF like BLOK could fit. You spread the risk across miners, infrastructure, tech.
Makes sense. Now, middle ground, moderate risk. I'm okay with more volatility. I want the potential for returns that beat Bitcoin in a bull market, but I still want the convenience of buying a stock on NASDAQ or NYSE.
That points towards public companies holding lots of Bitcoin. MicroStrategy, MSTR, is the prime example. You're taking on the stock-specific risks, their debt strategy, market sentiment swings. But the payoff can be significantly amplified returns compared to just holding Bitcoin or an ETF.
Got it. MSTR is the leverage stock play.
Yeah.
On the high risk end of the spectrum, I want maximum potential upside, I can stomach extreme volatility, and I understand there are external factors like energy costs or tech changes involved.
Then you're probably looking at Bitcoin mining stocks, Riot, Mara, CLSK, etc. They offer the highest leverage to Bitcoin's price, driven by their mining operations. But it requires nerves of steel.
And a good understanding of their operations, right? Not just the Bitcoin price.
Absolutely. You need to be comfortable with their operational risks, the impact of the halving energy markets. It's the highest potential reward, but also carries the highest risk of significant loss or even failure.
Okay. So the big picture takeaway here, the thing we really want you listening to remember, is that the old barriers to getting Bitcoin exposure, they're basically gone now, at least for traditional investors.
Totally dismantled. You can build serious, meaningful exposure to Bitcoin, whether you see it as a speculation, a diversification tool, or part of your retirement plan, all within your existing regulated brokerage account. No keys, no crypto jargon, no stress about getting hacked.
And looking even bigger picture, what's the fundamental driver here that's pushing crypto towards becoming truly mainstream, truly adopted globally?
It really comes down to that institutional embrace, particularly the reliance on regulated custody. The fact that trillions of dollars could potentially flow through ETFs managed by BlackRock, custodied by Coinbase, that builds an incredibly robust, trusted bridge.
So relying on these established regulated financial players is actually the key step.
It seems paradoxical maybe, but yes. That dependency on trusted institutional infrastructure is what's transforming Bitcoin from a niche digital curiosity into something that can be seamlessly integrated into global finance portfolios. It makes it accessible and investable for everyone. Hashtag tag outro.
You know, this whole shift, this massive success of spot ETFs and companies like MicroStrategy basically acting as Bitcoin proxies, it does raise a kind of fundamental, maybe philosophical question about crypto's original goals.
Yeah, it's a fascinating tension, isn't it? Bitcoin was born from this idea of decentralization, getting away from intermediaries, censorship resistance. But now its biggest growth engine seems to be these highly centralized, regulated Wall Street products funneling potentially trillions of dollars through established giants.
So the provocative thought for you to chew on is this. If Bitcoin's path to global dominance relies so heavily on these centralized custodians and traditional finance structures, does that ultimately strengthen or undermine the core decentralist principles it started with?
It's a complex irony. Definitely something worth thinking about as you figure out your own approach to this space.
Well, that brings us to the end of today's deep dive on navigating the world of Bitcoin investment without actually buying crypto. We really hope breaking down these sources and strategies was helpful.
Yeah, absolutely. And look, if you found this analysis useful, if it gave you some new perspectives or actionable ideas for your own portfolio, we genuinely rely on your support to keep producing these deep dives every week.
It really makes a difference taking just a second to subscribe to the channel, maybe leave a comment with your thoughts on this topic, or just hitting that like button. It seriously helps us out.
It boosts our visibility,
Mhm.
tells the algorithm that people find this valuable, and frankly, it allows us to dedicate the resources needed to research and create this kind of in-depth content for you.
So yeah, smash that like button. Please subscribe if you haven't already, and hit the notification bell so you don't miss the next one.
We appreciate you tuning in, and we'll catch you on the next deep dive.